Welcome to this conversation on Business Redefined. This is your weekly look at your weekly most comprehensive look at the world of business, finance, and economics. We want to talk about the state of the macroeconomic environment in the country. A lot has been happening. We have seen Supplementary Budget II. We have seen Kenya return to the market with a new Eurobond, which matures in 2036, raising $1.5 billion. We have seen an effort to partially refinance the Eurobond, which matures in 2027. And we want to make sense of all this. And of course, we've seen changes in the rate by rating agencies, notably by Moody's. And we are privileged this evening to have David Drogovic, Vice President and Senior Credit Officer at Moody's. David, thank you so much for creating time to speak to us.
Thank you for having me here.
David, let's start with the biggest news that we have seen so far. Kenya returns to market with a Eurobond and making an advance move in terms of partially refinancing the Eurobond, which matures in 2027. Many of us had not anticipated this. What's the liability management play here by the government?
Yeah, so we put out something last week on the issuance and the buyback. This is something that certainly helps alleviate some of the near-term amortizations that the government faces. They have very large external amortizations every year, this year, out through the rest of the decade. And so the liability management operation, the new issuance, comes as a way to refinance or buy back some of these upcoming maturities, some of these more expensive syndicated loans. So it's part of a strategy of improving the overall debt profile for the government. And it's something that we've spoken about in the past or before. We're saying that for a country like Kenya, with the amount of debt that it has coming due, the amount of debt has coming due to bondholders, it will have to become a more frequent, more regular issuer in the market. And we've seen that now twice with two issuances, one this year, one in February 2024, ahead of the large $2 billion maturity.
But the appetite for the buyback, we thought that we would have seen the entire $900 million principal amount being snapped up. It didn't hit that amount. What could have been at play here?
There are different factors at play, right? I don't know the full amount that was tendered by bondholders, but some holders may prefer to have a shorter maturity bond, right? The bond buyback was for a bond that matures in 2027, but it amortizes. So the first amortization was this year, 2026, 2027. So there may be some factors there that certain holders prefer to hold the shorter duration bond versus exchanging for the longer duration bond. Beyond that, the key point for us is that the government did raise more than the 580 million that they bought back, the 1.5 billion. So that's going to help reserves. That's going to help the government as they have other maturities coming due. There are syndicated loans coming due this year and next year that are quite expensive. So to the extent that this issuance helps, that overall this is a positive.
But David, we know that concurrently the government is in talks with the government of the UAE for private bond issuance, targeting again $1.5 billion. And many of us are asking ourselves one key question. Given the sequencing of events towards building up the war chest in terms of financing, are we still anticipating the 9th review of the IMF program to come through with a disbursement?
Yeah, that's a really good question. And at first, I'd start off by saying that the government has been very successful with this program, completing the first 8 reviews, very few with delays other than the last one. And I think from both sides, from the IMF and from the government side, they would like to see a conclusion of the program. Now, there are some quantitative targets that the government may miss in the 9th review. There's also a limit on commercial borrowing. So depending on how the UAE loan is viewed by the IMF, they could breach the ceiling there. All of which could complicate the 9th review. But I think from Moody's, the rating agency perspective, the government is these two issues of the Eurobond issuance and the UAE loan is demonstrating that the government has access to varied sources of external financing in sufficient quantity to meet upcoming maturities.
And just now that you've touched on the IMF, so I spoke to the IMF Director for Africa, that's Abebe Selassie, about the misgivings the IMF has around the UAE facility, and he told me there are concerns about the pricing of commercial loans like that one. But I was like, look, if you look at what Kenya paid for the Eurobond refinancing in early 2024, vis-a-vis what we're being offered, at least what the Treasury has told us for the UAE facility, the pricing doesn't look that bad. What could be the issue here?
Yeah, I would agree that the pricing is not the issue, right? I mean, you compare it to what the government borrows domestically, right? There's no FX risk there, but it's much cheaper there. The UAE loan, a little bit above 8% is cheaper than the Euro bonds. It's cheaper than syndicated loans in the past. I think it has more to do with the quantum of the borrowing, in addition to the Euro bond that they issued, and the overall sort of commercial borrowing limit, because it's clear it's not concessional either, right? It may not be market rates of near 10%, but it's not the rate that the IMF and the World Bank and other multilaterals would lend at either. So it is somewhere in between that, and I think that it has more to do with the quantum than it does the actual cost.
And coming back to the domestic market, so late last year, we saw Kenya's inaugural bond issuance calendar. We did anticipate that we should have seen a bond switch auction towards the end of 2024 and at the start of 2025. We did see that, but we have seen a buyback in the domestic market. What did you make of this change in play from a bond switch auction to a buyback?
Yeah, I mean, I think it has to do with market conditions. We've seen a very steep decline in borrowing costs. So, going through the buyback route, it would remove or eliminate any concerns that we would have over whether it's a distressed exchange or whether it's forcing investors to exchange into a new bond. So a buyback, clearly making it, there may be a reason there that the government or the central bank targeted this buyback rather than a liability management exercise. But overall, I mean, I think the two are viewed similarly in terms of you can borrow new money, you can borrow in the market at a lower rate today, or in sufficient quantity today to address the upcoming maturities. And I think to some extent the Treasury and central bank have learned from the 2023 experience when there was a bunching of maturities in March of that year that created some liquidity pressure. So if you can get ahead of that, just like they did with the Eurobond, this helps to alleviate or address any potential liquidity concerns before they come and before they lead to a rise in borrowing costs.
David, now let's talk about ratings. And you have been at the center of this. So Moody's comes with a revision of Kenya's outlook to stable. The African Union critiques your ratings. First of all, David, just walk us through what you normally go through when you're coming up with this ratings analysis.
Yeah, I'll do that. Just when we went from CAA1 negative to CAA1 positive, so not stable, we went from a negative outlook to a positive outlook. Now, what goes on? The committee, a rating is decided by a committee. So there's a process. There are checks involved in this to ensure that we follow all the standards and requirements of the regulators and of the standards we set for ourselves as a rating agency. What was involved here in the Kenya case was from July, when we had the last rating action, July 2024. What we had seen was a very significant decline in domestic borrowing costs, very strong appetite from the local market for domestic securities. On top of that, we saw the central bank accumulating international reserves, notably through buying dollars in the market while the exchange rate remained stable. This was clear. These were two positives. And then lastly, what happened was when we saw the amendments to various tax legislation that increased our confidence that the government would be able to achieve a degree of fiscal consolidation that was in line with our projections or with our forecast for this year, and that this would help to, over time, lead to an improvement in debt affordability, what we measure as interest payments to government revenue.
And what would be your response to the concerns being raised by the African Union?
Look, we get this criticism. We understand that there are concerns over the ratings we have, and there's a perception of bias. But we have to be open to it. We have to be cognizant of it, and we have to try to address it. We have internal metrics that we use to measure our performance. So we look at to ensure that a rating for a sovereign rating or a government rating is the same as a corporate rating, is the same as a bank rating in terms of what that rating means for probability of default or expected losses. And when we look at these statistics and we look at cumulative default rates over the last year, over the last 5 years, we don't see any bias in terms of our ratings in one region, like for instance, in this case, Africa versus other regions. And we see that default rates at the B1, B2, B3 on down to CAA rating levels have been consistent across regions. The other point I'll make here is, when we look at our ratings and you look at what the market implied rating is at times, when you look at bond yields on existing debt, our ratings are much more stable. And if you take Kenya in this case, If you looked at the 2024 Eurobond maturity, 6 months before it came due, we had a rating of B3, which signals a very low risk of default over a 1-year time horizon, about 10% probability of default over a 1-year period, versus the market at that time had a much higher probability of default based on prices that were well below par. So our ratings are meant to be stable. They're meant to look through the cycle, and we have checks and balances to ensure that our ratings are consistent across regions and across rating classes.
David, I was a little concerned about your latest revision because part of it is pegged on the fact that we have seen tax laws amendments which look to recoup some revenue mobilization. But recently, the Treasury has downgraded the amount it targets by the new tax measures from 174.5 billion shillings to just 45 billion shillings. So I wonder to what extent then that recalibrates the assessment that you have.
Well, I mean, we always have our own view on the fiscal trajectory, on the deficit. So for instance, for this year, we had been at 4.8% since the July rating action. Now the Treasury's moved to 4.9% in the BPS. So quite similar to ours. And we have a slightly slower pace of fiscal consolidation next year. But I mean, look, we are aware that the Achilles heel or the challenge for the government has historically been to meet its revenue targets. There's only been a few years where they've met those revenue targets in the budget in the past decade, and it's been a challenge just to maintain tax buoyancy at 1. So we did discount the amount that they would receive from these tax measures. We have still a slightly lower revenue assumption than the government does. And when we look further out, our assumptions are based on revenue to GDP remaining roughly stable at around 17.7% of GDP. So we're not factoring in the same level of increase in revenue that the government is projecting. I think these forecasts reflect both a realism and reflect the past challenges the government has faced with increasing tax collection really beyond the pace of GDP growth.
David, every Kenyan, every market watcher looking at this market is wondering one thing. The IMF program lapses in April. What does the road ahead look like? There have been indications that we're already in talks for a new program. Will it be funded? What sort of architecture will it take?
Yeah, what I would say about the IMF program is, again, it's been highly successful for Kenya for the last 4 years through a period of market volatility. I don't remember who said this, but somebody said that the IMF program is kind of like you go to the hospital and you're a patient and you're sick, you go there, but eventually you recover and you leave the program. In this case, Kenya, what we're looking at is, the fiscal. Are they fixing the fiscal problems that they had in the past? Are we confident that the deficit will now be at a level that can be easily financed domestically and externally at prices that are not going to lead to deterioration in debt affordability? So whether you do that with an IMF program or without one, the IMF program clearly would anchor market confidence that fiscal consolidation will remain in place and that the government will take steps or corrective measures to ensure a degree of fiscal consolidation consistent with debt coming down over the medium term. At the same time, countries don't remain in IMF programs indefinitely. So if market conditions have improved and the government has access to international markets, has access to other forms of external financing that aren't going to, again, lead to a deterioration in Kenya's debt affordability, then from our perspective, having an IMF program or not having an IMF program isn't going to move the rating on its own. It really goes back to the fiscal, and can this government deliver on the fiscal consolidation that it's promised.
If the 9th review doesn't come through, as I would suspect myself, I'd imagine that has implications for the World Bank DPO, which has again been penciled in at $1 billion in the current financial year. Don't you think then challenges in the 9th review would further compound Kenya's fiscal stress?
It will be, depend on what the World Bank does with the DPO, right? But at this point, with the amount that they've bought back, when you combine the UAE loan with the remaining portion of the Eurobond, they would cover the amount that they expect from those two creditors through these recent borrowings. Now, again, these were meant for liability management, for buybacks, or to retire maturing debt. So it does create some pressure. But again, I don't think the IMF program would be completely off the table. I think it's something that, they'll discuss the ninth review. It could be wound up or grouped up with the new program or discussions on a new program. And if you recall with the DPO, I mean, even before the government entered into an IMF program in 2021, the government was receiving DPOs in 2020 and 2019. And they are very close to the point where if you look at their what the IMF calls their debt carrying capacity, they are at a high risk of debt distress, and they have low debt carrying capacity. That could improve over time, and I think that would then expand the options of concessional funding that would be available to the government.
David, let's talk about Supplementary Budget II for the current financial year. You have seen the numbers. I was pretty surprised by the extent to which it is bumping up domestic borrowing. Even as we talk about favorable domestic borrowing conditions, clearly the yields will likely be ticking up. Don't you think so?
Yeah, and that's been our concern. That was our concern in July of 2024 when we had a negative outlook at the CAA1 rating level, is that without access to external financing or in sufficient quantity, you'd have to rely more on the domestic market, and that would put pressure on domestic borrowing costs. And that's what we're going to monitor, because you're right, there's been a significant revision upward of domestic borrowing this year on a net basis and for next year. And to the extent that that does lead to deterioration in interest payments or interest affordability, that would lead us more, we think about what moves the rating up or down or return to a stable outlook. Not seeing an improvement in debt affordability that we are expecting is one of those factors that could lead us to stabilize the rating at the CAA1 rating level rather than at the B3 rating level. Now, just to talk about domestic rates, we looked at this very carefully, right? And if you look at next year, the coupons the maturities are coming due, and you look at the interest rate on those bonds, you're at a break-even rate around 13.5%. So we're basically there now. If you look at the last auction, so any further decline in domestic borrowing costs from here, when you think about just rolling over maturing debt for next year, is going to have a positive effect on the interest balance. Then the bigger issue is, again, the net domestic financing. If it's close to 600 billion, that's going to put pressure on the interest burden. If it's closer to 500 or below, that would then help improve the debt affordability trajectory, or the trajectory for debt affordability.
And David, on that point, now we have received indication from the government that the plan to securitize pending bills, state arrears, is now firmly on course. The Kenya Roads Board should be going to market. The arrangement is done by Trade and Development Bank. How does Moody's view this move? What are the implications on this, on the debt profile of the country?
Well, pending bills are a debt, right? It's something the government owes. It's not included in the debt stock, but at some point it has to be cleared. While they're pending bills, there's no interest payment on it. When you securitize it, you're then crystallizing this onto your debt, onto the government's debt stock. You're crystallizing it, incorporating it into your interest expense. Our view has always been with these bills is that the government would clear them as and when they have access to sufficient funding. So that if it were something that were going to lead to a rise in borrowing costs or create challenges for the financing of the fiscal deficit, that we'd see a slower pace of the clearance of pending bills. I think that's still the case here. They have every intention to clear them, and there would be a positive effect in terms of liquidity in the banking system, in terms of a second order effect on the economy and spending. So to the extent that this doesn't affect the government's borrowing costs, it's a positive. The size of the pending bills is large. I think trying to clear all that at once would be challenging, and so our baseline is that it would be done over an extended period of time.
Okay, and we are now looking forward to Finance Bill 25. We have received indications in the budget policy statement. The government is looking at about 300 billion shillings worth of additional tax revenue. Some of us, myself included, think that's a bit ambitious. I wonder how you're viewing it from your side.
Yeah, you're right. I mean, to describe it as ambitious, again, historically, you look at the government's track record in terms of increasing tax collection, increasing it as a share of GDP, and they've struggled with that. So to improve tax collection purely through efficiency measures and efficiency gains, I think is going to be challenging. I think for next year, you get the full effect of the amendments to the tax legislation that were done in December. So that will help But again, from our view, we take our view on the revenue trajectory is really that it stays flat as a share of GDP. So, it's increasing roughly about 10% year on year, which is in line with nominal GDP growth. The challenge would be, how do you adjust expenditures, or what's included in terms of the revenue assumptions in the budget, and how does that affect what the government sets as spending targets? Because again, the flip side to overly optimistic revenue assumptions has been setting spending at a higher level than is consistent with your revenue intake, and then that requires either borrowing more, and so we just talked about the domestic market at higher rates, or cutting back on expenditures. And so we'll carefully monitor what's in the budget, but our assumptions are really revenues to GDP staying flat around here going forward, and we'll see the further adjustment on the primary balance and on the fiscal balance. Most of it will come through a lower interest burden over time, and that would then facilitate or accommodate slightly higher primary spending.
As we dial down our conversation, David, so the government has indicated plans to diversify its funding sources. We're talking about panda bonds and many others, including even a debt swap. I wonder what you view as the path towards something like a panda issuance, possibly in the next financial year.
Yeah, I mean, this is something that's been talked about for a while, the panda issuance, the samurai bond, the debt for different types of debt swaps. All of these sort of transactions are really complicated the first time you go through them, and there are a lot of just getting the right bond documentation in place, getting everything set in place. That means it takes a long time. We're not factoring this in terms of our external financing for next year. So this could be an upside surprise, so to speak. What a lot of these issuances do is really it's meant, if it's a panda issuance or if it's a samurai bond, they're meant to finance purchases or imports from Japan or from China. So it would help on the FX side in terms of bilateral trade and having FX for purchases without really putting pressure on the dollar or on the shilling exchange rate. But beyond that, I mean, external financing, we look at the costs of it just like we would any other issuance, and if the terms are consistent with an improvement in the debt profile or not, that's what we're more focused on than if they will issue a panda bond, for instance, alone.
David, final question here. What's your broad outlook for Kenya in 2025 in terms of GDP growth, private sector momentum? We have seen significant contraction in terms of private sector credit. Does that concern you?
It does. There are a lot of headwinds both facing Kenya and the global economy. Our view, we have growth around 5% for this year. That's something that the economy's been able to sustain or maintain throughout most shocks. What we are looking for is, if we do see, I'd give it, a positive scenario here. If we do see fiscal consolidation, occurring, and we do see the government meeting its targets, that does create scope for bank lending to increase and to improve, and to have a positive spillover on the private sector in terms of growth. But I mean, again, as you alluded to earlier, there have been a number of taxes put in place, and there are challenges for households and businesses struggling in the country. So we're not expecting anything really above 5%, but we think 5% as a baseline scenario is reasonable, and we have inflation remaining within the central bank's target, a little bit more monetary easing from here. That all of it should create sort of tailwinds for the economy.
David Rogovich, thank you so much for your time.
Thank you, Julius.
We have been having a conversation with David Rogovich, Vice President and Senior Credit Officer at Moody's, covering the state of the macroeconomic environment right from the Eurobond issuance, coming to the point where we are talking about Outlook 25, including the supplementary budget, which is currently before the floor of the House. We shall continue monitoring these trends to bring you the latest as they unfold. Stay tuned.